With the rise of cryptocurrencies, many investors are eager to dip their toes into the exciting world of digital assets. However, constructing a well-rounded and profitable crypto portfolio can be challenging, especially for intermediate investors. In this video, we will explore the key principles and strategies to help you build a good crypto portfolio while keeping it accessible to those who are new to the crypto space. Research and education. Before diving into the crypto market, it is essential to educate yourself about the fundamentals of blockchain technology and the different cryptocurrencies available. 3. Familiarize yourself with terms such as blockchain, decentralization, smart contracts, and consensus mechanisms. 4. Learn about the leading cryptocurrencies, such as Bitcoin, BTC, Ethereum, ETH, and others that pique your interest. 5. Knowledge is your greatest asset in this space, so invest time in understanding the underlying technology and the specific projects you plan to invest in. 6. Diversification. Diversification is the golden rule of investing, and it applies equally to the crypto market. 8. By spreading your investments across different cryptocurrencies, you reduce the risk associated with any single investment. Allocate your portfolio across various sectors, such as decentralized finance, DeFi, non-fungible tokens, NFTs, and privacy-focused coins. This way, if one sector underperforms, your portfolio will still have the potential to generate returns from other areas. Risk assessment and management. Cryptocurrencies can be highly volatile, with price swings that can be both exhilarating and nerve-wracking. As an intermediate investor, it's crucial to assess your risk tolerance and invest accordingly. Avoid investing more than you can afford to lose and set realistic expectations. Consider dividing your investment into different risk categories, such as conservative, moderate, and aggressive. Allocate higher percentages of your portfolio to more established and less volatile cryptocurrencies, while reserving a smaller portion for high-risk, high-reward assets. Dollar cost averaging, DCA. Timing the market is a challenging task, even for experienced investors. Dollar cost averaging is a strategy that helps mitigate the impact of short-term price fluctuations. Instead of investing a lump sum all at once, consider spreading your investment over regular intervals, such as monthly or quarterly. By doing so, you can take advantage of market volatility by buying more when prices are low and less when prices are high, resulting in a favorable average purchase price over time. Research and analyze projects. Investing in cryptocurrencies requires a thorough evaluation of the projects you plan to invest in. Look for projects with solid fundamentals, an experienced development team, and a clear roadmap. Assess factors such as the project's use case, adoption potential, market competition, partnerships, and community engagement. Stay updated with news and developments in the crypto space, as well as regulatory changes, as these can significantly impact the value of your investments. Consider long-term investment. While short-term trading can be exciting, it often requires constant monitoring and can be highly speculative. As an intermediate investor, it is advisable to consider long-term investment strategies. Identify projects with strong long-term potential, based on their technology, adoption, and community support. By holding on to quality cryptocurrencies for an extended period, you can potentially benefit from their growth and overcome short-term volatility. Consider the role of Bitcoin. Bitcoin, often referred to as the king of cryptocurrencies, plays a significant role in the crypto market. As an intermediate investor, it's important to understand the influence Bitcoin has on other cryptocurrencies. Bitcoin's price movements often have a cascading effect on the overall market sentiment. Therefore, monitoring Bitcoin's performance and considering its impact on your portfolio is crucial. While diversifying across different cryptocurrencies is important, having exposure to Bitcoin can provide stability to your portfolio due to its established track record and large market capitalization. Understand the importance of wallet security. Investing in cryptocurrencies requires safeguarding your digital assets. The security of your crypto holdings should be a top priority. As an intermediate investor, familiarize yourself with different types of wallets, including hardware wallets, software wallets, and custodial wallets. Hardware wallets, such as Ledger or Trezor, offer enhanced security by keeping your private keys offline. Use strong passwords, enable two-factor authentication, too far, and be cautious of phishing attempts and malicious websites. By prioritizing wallet security, you can minimize the risk of losing your investments to cyber threats. Keep emotions in check. Emotional decision-making can be detrimental to any investment strategy, and cryptocurrencies are no exception. The crypto market can be highly volatile, leading to significant price fluctuations within short periods. As an intermediate investor, it's important to keep emotions in check and avoid making impulsive decisions based on market hype or fear. Stick to your investment plan, rely on thorough research, and be patient during market fluctuations. Embrace a rational and disciplined approach to investing, focusing on long-term goals rather than short-term price movements. Stay informed about regulatory developments. The cryptocurrency market operates within a regulatory landscape that continues to evolve. Governments and regulatory bodies worldwide are increasingly addressing the crypto space, which can impact market dynamics. Stay informed about regulatory developments in your country or region, as changes in regulations can have a significant impact on cryptocurrency prices and the overall market sentiment. Being aware of legal and regulatory frameworks will help you make informed decisions and adapt your portfolio accordingly. Rebalance and monitor your portfolio. Once you have established your crypto portfolio, it's essential to monitor its performance and periodically rebalance it. Regularly review your portfolio to ensure it aligns with your investment goals and risk tolerance. As certain cryptocurrencies may outperform or underperform others, rebalancing involves adjusting your portfolio by selling some assets and buying others to maintain your desired allocation. Rebalancing allows you to take advantage of opportunities and prevent your portfolio from becoming too heavily weighted towards certain assets. Seek guidance from experienced investors. 12. While this video provides a comprehensive guide for intermediate investors, seeking guidance from experienced individuals can be invaluable. Engage with the crypto community through forums, social media groups, and online communities dedicated to cryptocurrency investing. Listen to podcasts or watch interviews with successful crypto investors and industry experts. Learn from their experiences, insights, and strategies to further refine your approach to building a strong crypto portfolio. In conclusion, as an intermediate investor, constructing a good crypto portfolio requires a combination of knowledge, strategy, and careful decision-making. By conducting thorough research, diversifying your investments, managing risks, and staying informed, you can navigate the crypto market with confidence. Remember to prioritize wallet security, control your emotions, adapt to regulatory changes, and regularly monitor and rebalance your portfolio. With time, experience, and a disciplined approach, you can increase your chances of building a successful crypto portfolio that aligns with your investment objectives. For more information on how to make a good crypto portfolio, please click the link in the description. If you like this video, please give it a thumbs up, comment, like and subscribe. Happy investing!